Good afternoon, everyone. Welcome to the final session of our Growth Funds event. In a few minutes, we'll be hearing from Sam Vecht and Emily Fletcher, managers of BlackRock Frontiers Investment Trust. BRFI has had a very strong 2021. In fact, it's one of the top performing trusts in the emerging market sector with returns of roughly 22%. The discount remains around 8.2% as of yesterday's close. Having said that, shares are up around 13% year to date compared to the MSCI EM being roughly flat, so it's still been a good return for shareholders. With the theme of the event being growth, clearly the investment universe of BlackRock Frontiers has a lot of countries with strong growth potential, and no doubt we'll be hearing about some of those later on. So I'm shortly going to hand over to Sam and Emily. They want to be a little bit more, to improvise a bit. So if you put your questions in the box on the right, then they will answer them as we go through. So with that, I will hand over.
Good afternoon, everyone. Hopefully you can hear us and potentially see us too. We're going to go through a few slides, but as always with our presentations, please ask questions. It's far more interesting if people ask us questions than we just speak for the predetermined amount of time. And as per the last time we did this event, we will try to answer all questions and not leave out the difficult ones. So without further ado, if we kick off with the first slide. And I think if we sort of think what this trust has always been about, the messaging that we're giving today is no real change in that regard. We are investing in a series of countries with significant amounts of growth, countries that are not yet fully appreciated by most investors, countries where the companies generate significant dividend yields, companies and countries that aren't highly correlated with other markets around the world. And that's really the story that we've been telling since 2010. And it is the story that we continue to be telling today. Now, if we just have a look at the slide here, the colors of the countries that we invest in are color-coded by continent. And really, what we're focused on is investing in countries and companies that support 3 billion of the world's poorest people, in a world increasingly focused on matters ESG and people really wanting and doing better for not just themselves, but for society by their investments. I think it's really important to highlight the fact that there are very few ways to influence the outcomes of economies and lifestyles for the poorest people in the world. And this is one of the few ways that we can have an impact on the poorest 3 billion people. So we are directly, through our investments, changing how people are deploying capital in these countries. And we think that's a really big duty and a responsibility that we carry. And so hopefully you can see the different countries and regions that we invest in. As I said, please ask questions throughout. I hand over now to Emily to take us through the next 4 or 5 slides.
Thanks, Sam, and good afternoon, everyone. So as Sam said, this is just on this slide, you can see our universe, and just to remind you what we do. So this trust will not invest in the largest 8 markets in emerging markets, the largest 8 countries. So that leaves about 15% of the emerging market universe, which we will invest in then all of frontier market countries. And you can see from the map what sort of countries that means. I think you can see highlighted all the countries where we have investments. And if we move on to the next slide, perhaps you can give it an idea of just sort of some of the sort of themes that we're playing in the portfolio. So that's investments in fintech, in payments across a number of different markets. It's investments in healthcare, as we referenced on the previous slide as well. And really, as Sam said, reaching out into some countries where it's really difficult to get investments through other different vehicles. So over the next three or four slides, I'm going to take you through a couple of reasons why we think these markets are really interesting at the moment, and areas where our portfolio is currently invested. And this slide is a little bit higgledy-piggledy, so please excuse us for that. But what we're really trying to show here is that what we saw throughout 2020 or throughout the second half of 2020 and through 2021 is a really significant recovery. Obviously, as we've seen in the rest of the world, our markets were a bit different in that during 2020, although we actually saw, as you can see from here, quite a lot of that recovery, we saw very little market performance. And then going into 2021, we've seen substantial catch up. I guess as people really starting to believe that actually we will see economic normalization in some of these countries. One of the regions in the world that really has been lagging would be the Southeast Asian region. And it's really hard to see in this chart because the red line is placed quite a lot above the yellow line. But you can see actually that whereas, for the majority of the world, we're actually at mobility trends that are way above even where we were pre-COVID. Actually, for the Southeast Asian markets, they've been really lagging. A little bit of recovery in the last few months, but still really lagging. And so one of the areas of the world where we're still holding sort of very simple just recovery plays on economic activity improving, and some of those doing well in the portfolio. So one area that we like at the moment. Another area where we're seeing opportunity, moving on to this next slide, would be from some of the dislocations that we're seeing in the world. And I'm sure you will have heard about this from a number of different portfolio managers, but as a result of some of the impacts from COVID, we're seeing quite a lot of dislocations in supply chain. Actually, for us, it's quite interesting. We reference here particularly China freight price. Actually, if you go back even to pre-COVID, some of the disruptions we were seeing in trade relationships, particularly between US and China, was actually leading to quite a lot of production of goods being outsourced. So we have a few areas in the portfolio that really benefit from that, and one of them being Eastern Europe. So within Eastern Europe, we're seeing that the countries there are benefiting quite a lot from nearshoring. So European production, base for the European production for the European market, moving into Eastern Europe just in order to try and reduce those delivery times back to what we're used to, and to just offset that increase in the price of freight. So that is one of the areas we think is doing really well. And you can see that in economic activity and in that performance of the Eastern European market, that it's really benefiting from that coming through. One of the other areas that we think is really interesting, and this one I think we're going to need to look at in conjunction with the next slide. So, is what we're seeing in the commodity prices and commodity markets. So we've just given a single example here, which is Indonesia, and this is its trade balance. Indonesia is a big exporter of coal, not so environmentally friendly, but still required in some parts of the world. But also of other commodities as well. And you can see as a result of that, as a result of the fact economic activity hasn't fully picked up in Indonesia yet, that the trade balance has done really well. And this is not just really well in a sort of 1 year context, it's actually at an all-time high. And we're seeing that in quite a few countries around the world. A lot of the places where we invest are big exporters of goods to the rest of the world. And as a result of that, they've seen significant improvements as we've seen demand pick up in the West for a number of these goods, and pick up faster than we're seeing in emerging markets. And that's really just taken some of these trade balances right back to where they were, as you can see here, sort of 2008, 2009, 2010, a time when emerging markets was in a really different place to where it is now. And I'm going to just move on slightly to the next slide, which Sam will probably touch on in a bit more detail. But just, I think, remember what you saw on the previous slide and now translate it to this. So,
yes, exactly. It may be a bit strange. Both Emily and myself are back in the office, but we're on different sides of a bank of desks, which is why there's a slight disconnect between us speaking. So what's interesting about our frontier markets is the fact, despite we're having the growth that comes from these countries growing 5 to 8% a year, despite the fact that we have the growth from our companies growing 10 to 15% a year, despite the fact that these countries have recovered from COVID, in many cases didn't suffer from COVID for various reasons to the extent that us in the West did. Despite all of that, and despite a decade of decent performance, these markets continue to lag behind. And it's kind of been a surprise to some extent for the, Emily and myself have been going around saying the same story for 10 years. What's really happened over this 10 years is the companies have delivered, but the market hasn't. So our markets continue to be extremely cheap compared to our index, compared to the world. And as people go and crowd into ever more expensive, often US listed stocks that make no money, we do find it strange that our collection of, I would suggest, fairly ESG friendly investments continue to attract very little interest. Our fund trades on 10 times forward earnings. The book values are extremely cheap, as well, as you can see here. And what's really quite noticeable is that people have not paid attention to the growth that these markets offer and continue to, not necessarily derate them in the last year, but hardly re-rate them. And obviously, over the last 10 years, these markets have derated. And if we go through to the next slide, we have a little bit about our country positioning. What we have here are the countries. You can see it is a very diversified collection of countries, from Saudi Arabia, which is a big absolute weighting, but quite a big underweight, past countries in Southeast Asia, Indonesia, Vietnam. It's a whole collection of countries like Kazakhstan that many people don't often think about, but have been one of our best performing countries over recent times. And these are exactly the countries that pretty much no other fund will give you access to. As Emily said earlier, they represent 10 to 15% in total of most emerging market funds, often even less. Emerging market funds focused on those big 8 countries, China, India, etc. And these countries, which are growing faster, don't necessarily have the economic challenges, for example, that China is facing, look a much better opportunity set for us today. And we say that, I say that even as an emerging market manager. If I look how some of our broader emerging market funds are allocated, they're much more heavily weighted to these countries than they are to some of the large 8 emerging market countries. Now, on the next slide, we have our breakdown by commodity, and the reason why by industry, the reason I wanted to highlight this slide is we've had a question in to what extent is the fund invested in commodities, and you can kind of see that here. It is not that heavily invested in commodities. You can see materials is about 9%, energy is about 9%. Typically, we have no more than 20% invested in commodities. The vast majority of our fund is invested in companies that are beneficiaries of domestic growth. You can see financials is a large portion of that, but obviously financials is not just banks, it's insurances, it's stockbrokers, it's lots of different things. It just happens to be at the moment, given where we are in the cycle, we have a fairly big weight in financials, is actually slightly below the index. But great that we're having some questions coming in, and I'm going to try and tackle a couple of those here. We have a question: how much of the process in reality is top down? Emily, over to you.
Thanks, Sam. So for us, it's a very significant portion of the process, and that's because at the end of the day, we're dollar investors, and we think that it's all very well having your own your lovely little company that's doing extremely well, but we all know if you were to take any one of these countries in and of themselves that they can be quite volatile. They can be affected by what's happening in politics as well as what's happening in economics, and those can be quite volatile in and of an individual basis. So we think that when you are making an investment into any of the companies that we hold, that understanding that context of the country in which it operates and that political framework and economic environment particularly, and those will manifest in what the bond market is doing and what the equity market is what the currency market is doing, are really important. And we really want to be investing in the countries where we have a positive view on the equity market, the bond market, and the currency market. And then you get the positive reinforcement of the performance from all three, which we think is really how you drive the long-term outperformance.
Yeah, and I just want to come in. So the standard line that you may have heard us say previously on this regard is when a currency goes down 10%, the market goes down 20%, and then you lose 30% in a week, and that's what happens. Now, it's important to highlight, while we have a very clear top-down process, and there's certain countries that we just will not invest in currently because we're worried top-down, and there's no country that we have to be in. Often if one has, I don't know, a single country fund, you'll find that the fund managers are just perpetually positive on that country because they have nowhere else to go. That's exactly what we don't have to do here. There's not a single country we have to be in. And in fact, every single one of our biggest countries that we have big weights in today, let's say north of 8, 9%. All of those countries at some point over the last 10 years, we've had zero in. And that's because we are not tied to any country. While we're talking about the top down, it's really important to emphasize that the majority of our risk is bottom up. And we will not invest in a company unless we've met them. We insist in meeting companies, customers, suppliers, and competitors. We insist in spending a lot of time on the ground. And to that end, already now that COVID is hopefully winding down, I've already been to Turkey to look at some of our investments or potential investments. I've been to Uzbekistan, not necessarily a country that many people think of in terms of investment today. I spent this morning going to a Bangladeshi conference. It's really important that we spend time seeing our companies, as I said, but not just the companies, because management sometimes are a little aggressive with what they say, but see their customers, the suppliers, and the competitors. And that's really, really important for us. So I'm sorry if we're breaking up the presentation, but going through questions, but I think that's always been what we've done historically. It's kind of helpful to address people's questions. And we have sort of two questions on nearshoring coming up. Firstly, give us examples about how we're sort of seeing the European nearshoring trend in Eastern Europe, and I'll just deal with that quickly because one of the great stories for Turkey, other than the political challenges the country have, is as people see the problems that are going in China, as people have seen supply chains disrupted because of COVID, and people worry about this happening again. We've seen a lot of nearshoring, people moving their production capabilities from China to Eastern Europe, and Turkey's been a very big beneficiary given its cheap currency. So that's absolutely something that we were investigating in Istanbul and in Ankara just 10 days ago, seeing lots of companies, seeing economists and everyone talking about this very clear nearshoring trend, which has actually helped the country in what otherwise would have been a very difficult situation given some of the political challenges. And then a somewhat related question that we have here.
Hang on, Sam.
Sorry?
Can I just jump in there as well? I just want to add one more thing. I mean, because I think the other area where we've held really playing that is just through some of the Eastern European banks. I just wanted to give you some of the statistics within Eastern Europe that we're seeing at the moment. So Romanian GDP up 14% year on year, Polish industrial output up 9% year on year, Greek retail sales up 9% year on year. I think those statistics are quite standout. So what we're really trying to say is those economies are doing really well. And so the plays we have are quite diversified, some financials, some retail, but it's really about that providing a big support for domestic economic growth, which is the theme that we're really trying to play there.
And then the next question, and we're trying to go through as many of these as we can, your view of the impact of COVID restrictions on industry in Vietnam. That was kind of another related. Emily.
So I'm sorry, we're jumping around. So yes, I think COVID restrictions did have quite a big impact over what was our summer. So Q2, Q3 in Vietnam, we're actually seeing the majority of those being lifted at the moment. So I think that did have some impact on production, but we would see it as quite transitory. And actually, Vietnam is one of the places where it just hasn't been impacted to the same extent by COVID. And so we're expecting that strong export growth that we've seen in the past few years to resume as we come out of COVID.
Okay, let's take a little pause from the questions here. There's at least another 12 I need to get through, which is good. And let's carry on, Emily.
Thank you, Sam. So one of the, I guess we've got sort of a couple more slides just to go through. This one, I think, just showing low volatility. I think this is really important to talk about in the context of how I mentioned that some of these countries can be individually and of themselves volatile. Actually, what's really interesting is when we put them together in a portfolio, they become a lot less volatile. And you can see here, less volatile than almost any other index over extended time period. And that's really because all of these risks are very idiosyncratic. So when one country is having a coup, it really has no impact on anything nearby. And something happening in terms of Vietnamese exports because of COVID, it's going to have no impact on what's happening in Kazakhstan or Argentina. So because of all those risks are very distinct from each other, very idiosyncratic. Actually, what we see is a portfolio that has just really low volatility in aggregate, and this always surprises people. And to just go through the next slide, I think it's we want to highlight the dividend that their trust pays, which again is something I think that's just a bit surprising given how we talk about a lot of growth that we see in these countries. For us, it just really comes from the valuations that we're seeing in these markets. And these are not countries that are at all hot for investors to be getting into, and therefore companies just really have this need to reward their shareholders with dividends. And we're not an income-seeking trust at all. This is just natural consequence of where we invested. The companies that we invest in, just this real culture of paying dividends that, again, I think quite stand out and unusual. So I don't know if you want to go through a few more questions.
Yes, I want to touch on this slide because it touches on the next question. Just in case people are interested, I'm up to the questions that came in till 3:14, so I'm 6 minutes behind in terms of questions, and we'll go through them. I'm not going to name the people asking the questions, but we're up to 3:14, so I've got quite a catch up to do. This is an important summary slide because it really tells you really what we've been doing for the last decade. The same team, the same process, the same philosophy. And it's really about the growth of our markets. Our markets are growing fast. Our companies are growing fast. They are paying out a dividend yield, and this is a covered dividend yield, as anyone who looks at our daily NAV would see. As Emily said, we're not aiming for this. It's just an outcome of investing in a collection of companies that are very cheap and are generating cash. Cheap valuations, as we highlighted, and low volatility was mentioned. So that's kind of what these markets have to offer, and very few people have the scale to be able to be looking at these 30 or so different countries. Anyone can look at a single country, but looking at all of them together is actually fairly challenging. What do we add as a sort of fund management house? We have active management. As we said, we don't have to be any of these countries. We want to be very active. Anyone who wants to own passive investments here, that's a pretty dangerous thing to do because, as Emily was alluding to, all of these countries at some point over the next 5-10 years are going to have coups, crises, and credit collapses. We focus on hard currency returns. We're not interested in people talking about, currency adjusted issues or returns in Kwacha or Naira. We focus on returns in hard currencies. Everything else is just promotional stuff. We focus on liquidity management. All our stocks trade every single day. We could happily value our entire fund in 5 seconds on Bloomberg, as could anyone else. We don't invest in marked make-believe stocks, no pre-IPO situations, no fun and games there at all. And this takes me on to the final point, which is discount management, which was the question asked at 3:14. How do you manage the discount to NAV? And unfortunately, we've now actually opened out to a bit of a discount to NAV. Currently, as was highlighted earlier, for the first 10 years of our lives, we were rarely at a discount, actually slightly at a premium. We have a 5-year life, which is how we manage the discount to NAV, which means all investors can redeem some or all of their shares every 5 years at NAV less cost. We went through that process at the beginning of 2016. We went through that process at the beginning of 2021, and we would anticipate doing the same thing at the beginning of 2026. And obviously, anyone who's investing in this fund should be a long-term investor. And then if at the beginning of 2026 there is still a big discount, you will be able to get your money out at NAV, and so can everyone else. And if people don't like what we're doing, then they could redeem the entire fund. We are not believers in evergreen funds where boards go and change the rules to ensure their fund managers have perpetual employment. That's not what we're about. We believe in shareholder democracy, and if people don't think we're doing a good job, then we do not deserve to be employed. That's how we control the discount. We think we are doing a fairly good job, but we would say that, but we let the market decide whether we're doing a good job, and that's how we control the NAV, and it's kind of worked to control the NAV discount thus far. The next question, now it's still at 3:14. Given our responsibilities at BlackRock, how much of our time is spent on BRFI? Do you have a sizable stake in the trust? And the answer to that is we spend a lot of time on this fund, hence me going off to Uzbekistan and Turkey. In fact, the first 2 places I've been to post-COVID have been able to get to post-COVID. So an enormous amount of our time. And the response in terms of our investments in the trust is, as was mentioned, I do manage other funds. I have 0 investments outside the funds I manage. So I have some cash. I actually live in a house, remarkably. But I have no other investments, nobody else's funds, no other funds outside BlackRock, no shares, absolutely nothing. I only own my own funds. I could not be less diversified than that because I feel I have to be completely aligned with our clients. And in case you're wondering, it's not like we have money in my wife's name and she's got other things. No, it's exactly the same is true for her. So no investments apart from the funds that I manage. So very much exposed to the funds that I manage. Is corruption a factor in your assessment of suitable investments? Yes, absolutely. Unfortunately, we invest in a series of companies and countries that are not known for being, as it were, whiter than white. That said, it's kind of interesting that in the 10, 11 years that Emily and myself have been doing this, only 4 companies we've invested in have turned out to be frauds, complete frauds, or largely fraud-like. And all 4 of them have been London listed. And that's kind of rather sad, I would say, about UK regulation. But yes, absolutely, corruption is something we think about all the time. And obviously, because we're at BlackRock, that is very central to what we're doing. Somebody
kind of a hot topic on the BBC website as well today. So I think it's something that we should consider in all investments that we make in all regions in the world.
Yes, somebody's asked, can you put up the country positioning slide? That's an easy one to do, up to 316 here. But in the meantime, someone has said LATAM ex-Brazil has been a very poor region in the last years, and Turkey's been horrible. Any catalyst you can see to change that? In fact, LATAM, including Brazil, has been even more awful than LATAM ex-Brazil. I think in all of these cases, it's about finding the country at the right point in the cycle. Countries where perhaps we're going to see positive political change, that may be true in Turkey or indeed in Brazil over the next 2 to 3 years. Countries where they haven't been over-investing and they haven't been stealing from their children's future to finance Big Mac and fries in 2020. And one of the big stories for most of our countries is they didn't go on some ridiculous spending bubble in 2020 to ameliorate the effects of COVID, which is very different to what we see in the developed world. So what are the catalysts? The catalysts are positive political change, the market's getting cheap enough, the bond market's getting cheap enough, and that's actually true in a few of these countries. Peru would be an interesting example of a place where market got very cheap, and that gave us an opportunity to enter. It's not a country that many people often look at, but that's definitely a situation that we should think about. Can we, Emily, I'm going to hand over to you because otherwise I sound like I'm monopolizing that. Thanks for the weighted PE and price to book. In the past, I think you've showed a weighted portfolio growth number, 5 or 10% EPS or revenue CAGR. Do you have anything like that to hand? Yes, it's still the same 10 to 15% that we've been talking about. Not very much changes in that regard. Have you decomposed your historic performance, country selection and stock versus stock sector selection? Emily, over to you.
Thank you, Sam. I will try to talk as fast as you. It's certainly a challenge. Luckily, you're still making me laugh, and same jokes still work 10 years later. So yes, we have decomposed it. It's normally about half-half between country allocation and stock selection. Obviously, at different periods, it can vary between one and the other, but generally it's about 50-50 with both being positive. So we do feel that adds credence to the way that we describe our process, that we think understanding macro and political environment is really important for these countries. Sam, as you're recently in Turkey, let's hand this one back to you. Does Erdogan need to go to make Turkey investable?
Yeah, I don't think he needs to go. I think any country to be investable has to have the right macroeconomic framework. And any country that does have the right macroeconomic framework where they consider the long-term implications of their actions, and this would be true in all countries, becomes investable at the right price. So he doesn't need to go. And we've definitely had plentiful investments in Turkey in this fund and beyond during the 18 years that he's been in power. But for any country to be interesting to us rather than investable, we have to have the right pricing, the right macroeconomic framework, the right political framework. I would just like to make the point that, people say, this country or this sector is uninvestable unless it's illegal to invest there, which it may be, let's say, true in North Korea, given the sanctions regime. Nothing is uninvestable at the right price. The big mistake that people make when it comes to frontier and emerging markets is thinking that anything is safe just because it's gone up a lot and then it becomes the next great theme or story. The most dangerous emerging or frontier market is one that people think is really safe and the sort of the go-to place to make money. That's a really dangerous place to invest. So the key thing for us at any point is to see what's priced by the market. At the moment, with the currency amongst the cheapest it's ever been in real effective exchange rate basis, and the market being amongst the cheapest it's ever been, Turkey looks interesting. I didn't say we have big investments there because we don't, but it's definitely investable. The question is the risk return in Turkey appropriate or better than that which we see in next door Greece or Poland or indeed Kazakhstan or Peru? And at the moment, we have fairly limited exposure to Turkey, as you can see on this slide, reflecting our view that we see better opportunities elsewhere. Next question. Do you have different valuation models for such differentiated countries' universe in order to take into account the different macro environments? Emily?
Thanks, Sam. It's good to give you a pause. Yeah, the answer is no, we don't have different valuation models, but we would have different cost of capital, I think. I mean, I think the way that we would categorize it is we like to have a very standardized approach to how we look at macro and the standardized approach in how we look at stocks, in order to get, full comparability. And then it's really about sort of adjusting, I guess, in formal basis, adjusting your cost of capital to reflect the opportunities that you see in the political and economic environments that you see. But for us, I think we believe that we really make money when we have a view on a stock, whether that's earnings or cost of capital, that's differentiated to the market. And it's when you have that differentiated view, which is then proved right, I think that you really make an outsized return. And in any other environment, the market is obviously is pricing that central case. So that's what we really look to do within our work, is try and find an edge in our views different to the market. I think the next question was, we show on Bloomberg that we have short CFD positions at 4.5% of our net. Yeah, if that's correct, can we comment? So actually, that we did have those. You want to talk, Sam? Go for it.
Yes, I was just going to highlight, if anyone looks in terms of our stock market release, you will see that our short positions at the end of September total 0.4%. It is true that, I'm trying to find the right month here, on the 28th of February, we had short positions totaling 4.5%, which is probably the highest it's been over the course of the last year. But we do release this every single month, but they may have been the February data you're looking at on Bloomberg. But if you look in terms of our monthly releases, which we release to the stock exchange, the last 3 months have been 0.4% short in September, 0.6% in August, and 2.3% in July. I stand corrected, it was 4.6% short at the end of June. So people have asked what's our shorting strategy. We short single stocks, not indices. We short single stocks, typically 1 or 2%, where we see there's a meaningful risk to earnings or a meaningful chance of a macroeconomic problem. These are alpha positions, not just hedges, as it were. And since we kicked off our fund, we've probably generated 4-ish% from short positions over the last 10 years. It's not massive, but it's just another tool in our kit. I know that 4-ish% number because we have to report it to our board every single board meeting, and we see our board papers, and it's very prominent there. We've got a board meeting coming up. So it's about that amount. Have we got all our short positions right? No, but at the margin, they've been helpful, as I said, giving us about 4% of overall performance since we kicked off. What are the key differentiators between the BlackRock fund and the Jupiter Frontier Markets Trust? I don't comment on other people's funds. I'm sure they are very good fund managers, and people will have to look at the different countries that other funds are exposed to. As I said, I won't comment on other people's funds for obvious reasons. Since we last met, your Saudi Arabian exposure has increased from 10 to 17%. How have the holdings Saudi market changed over the last 12 months in terms of number of holdings and fund weightings? We're up to 319. I'm now 14 minutes behind Emily.
Thanks, Sam. I'll go very quickly. So in Saudi Arabia, we have increased the weighting, have increased the number of holdings slightly. That's been a rotation. If you go back 12 months, we were holding stocks that were more exposed to commodity prices. We were expecting a significant rebound in the oil price. We've seen that. Our holdings in Saudi have rotated towards domestic exposure. We hold some financials and other domestics. We've done that because we think that where oil prices at the moment, Saudi Arabia has both the ability and the willingness to really invest in domestic growth. And we expect that to substantially accelerate. And particularly, we see opportunities in the housing market and around mortgage growth, where penetration's coming up from a very, very low level. So we're invested behind that at the moment. And as you can see, given the large absolute weight, we're still really pretty positive on Saudi and think that growth will continue.
Next question. What's the anticipated dividend for 2021, and is 2022 likely to be back to trend? Obviously, I can't comment on dividends. That's a matter for the board. The board did say that for the financial year, for us, which ends September 2021, they would pay out 7 US cents in dividends. They said that when it wasn't clear that the dividend would be covered, because people thought dividends would be cut. I make no future statement about the amount of dividends we pay out, but what I will say is that our company's payout ratios aren't changing very much, and they continue to grow earnings 10 to 15% a year. The biggest variability in terms of the absolute amount of the dividend in any year is which countries we're invested in. For cultural reasons, some countries, let's say like Nigeria, pay out very big dividend yields. We have pretty much no exposure to Nigeria, for example. Other countries, I don't know, Greece, Indonesia, if we were to give two of them, actually have fairly low dividend yields. So as we don't target a dividend yield, but we are fully conscious of the fact that it's very important for some of our investor base, and our board are aware of that. But in 2021, perhaps to some people surprise, our dividend, that's for the financial year ending September 21, for some people's surprise, our dividend was covered. And you know, it's a decision for the board what the dividend yield will be. How do your returns compare over 5 years with the frontier markets, MSCI frontier markets? First thing to say is that is not our benchmark. The frontier markets benchmark is a bit strange because, Emily, will you just remind us of what the frontier benchmark consists of today?
I hope I'm right. I think it's 29% Vietnam, 11% Morocco, and 9% Kazakhstan as the three largest holdings, and the top 10 companies represent 40 to 45% of the benchmark, of which at least 5 trade sub $2 million a day.
So yes, the bottom line is we've definitely lagged that particularly strange index, which is not really reflective of our opportunity set over the last 5 years. That said, over the last 5 years, we're roughly in line with our benchmark, having significantly beaten our benchmark over any other relevant time period, be that 3 years, 7 years, 10 years. So if this particular person wants to highlight that we've underperformed one relevant index over 5 years, they would be correct to do so. But if we look at slide 13, perhaps it gives us I think that's the one Emily has cleverly brought up while I'm rambling. You can kind of get a better reflection of our performance over really since inception. So you can see we had definitely a tricky 2014 and a pretty rubbish 2018. Apart from that, most of the years have been actually fairly good. And this year so far being fairly good too. Obviously, none of this would have been, you know, all of us, if we bought an ETF on NASDAQ, you would have beaten this. But then I guess many people wouldn't necessarily expect markets to keep re-rating in that market as well. What interests you about Saudi, your largest absolute country? Emily, you kind of touched that on, but perhaps you'd like to touch on that?
Sure. So I think there it's that at these oil prices, Saudi's running a fiscal surplus, that the government have stated, or political
Emily,
sorry, Sam. Sorry, I must have pressed something. That the government have expressed a significant willingness to invest in the economy in order to ensure that there is something there as oil production fades over the next 20 years. And particularly, we think that they have structural advantages in solar energy, where recent tenders have been at solar electricity prices of 1 cent per kilowatt hour, which would actually start to put them at the sort of costs where producing green hydrogen becomes competitive, something that's talked about a lot in the world. I think they have a structural advantage there. And in the interim, we still have mortgage penetration of 30%, retail loan penetration, I think that is actually, sorry, of about 30% of GDP, which is really, really low, and government support and subsidy to allow that to continue to grow. And I think mortgages have grown at about 20 to 30% over the last year. So a lot of money going into the domestic economy, which we think will support growth. And I think there's a follow-up question of how do we deal with ESG in Saudi? And again, you know, for all of as Sam talked about in terms of political context as well, you know, working to understand what is happening on the ground with all the companies that we invest in is really important. We obviously use the full might of BlackRock, which is very significant to do that. And it's important that we hold all the companies that we invest in to high standards. And we aim to do that through the engagements that we have with corporates. Sam, what more do you want to say?
I'd like to add, as a person who's not naturally aligned, the question was how ESG aligned is Saudi, and I'm a person who's not naturally aligned with Saudi personally. That said, it is the country in our universe that's probably changed the most socially and to some extent financially since I first went there in 2005. A really, really big change in that country. Is it a democracy like the UK? Absolutely not. But has lots changed that at so many levels completely. And so when people talk about ESG, it's kind of interesting listening to people sort of never sort of looking at absolute levels rather than looking at improvers. Emily, who actually runs our ESG strategy, is always at pains to point out the importance of looking at people or countries or companies that are improving, not just the absolute levels. And I think all that we can do as stakeholders to encourage and promote the positive changes that have gone on in Saudi, not all the changes that have gone on in Saudi are positive, but to promote those which are, is absolutely something that we should be doing as engaged stakeholders and as long-term investors in Saudi and in other countries. We have a massive role to play in encouraging the right movements, and that's a role that as BlackRock we absolutely play.
Can I just add one on that? There was a company we invested last year called Sipchem. It's a methanol producer. And one of the big disclosures in their sustainability report was that they employed their first female employee. And so there was a number of references about needing to build her a toilet. But I think, yes, we start on a lower base for a lot of our countries, but actually there's a lot of room for transformation. So we find that quite exciting. Thanks, Sam.
The next question is a recurring topic in the past has been what happens when countries move from frontier emerging indices? Is any movement currently anticipated? So as a reminder, we invest in everything below the biggest 8 emerging market countries. So if countries move from the fairly strangely constructed frontier market index to the emerging market index, that's not going to change what we invest in. We focus, I said, on the 3 billion people and the 90% of emerging market and the 10% of emerging markets that nobody looks at. It's really quite strange that these 3 billion people attract something like 0.2% of the average investor's assets. And that's just, for us, it's just ridiculous. As I said, in a world that focuses on ESG, these 38% of the world's population get 0.2% of the assets. That doesn't seem very fair, doesn't seem very logical, and it's not actually particularly economically sensitive. Where in the world are you finding the most exciting investment opportunities at the moment?
That's for me. So 3 areas that I want to highlight. First would be Eastern European financials. As we mentioned before, benefits of nearshoring as well, expecting some rate rises. Certainly, we've already started to see quite significant rate rises in Poland, Czech, Hungary. Then secondly would be in Middle East, particularly domestic names. Again, we expect to see an acceleration of growth, especially in Saudi, as we've talked about across the Middle East. And the third one will be in Southeast Asia, where we're expecting that economic recovery that we've seen in the rest of the world post-COVID that just hasn't happened there. And we're really waiting for that to come through, but particularly in Indonesia and Philippines. So more cyclical names in those 2 countries.
And I'm conscious that we're meant to only have 3 minutes left to answer all the questions. I'm happy to stay on if other people want to. I know it's the end of the conference at 3:45, but I'm going to try dealing with those until we run out of questions, until I'm told to shut up. Do you liaise with BlackRock Emerging Market Debt team on overview? Absolutely. We spend a lot of time traveling with them. We speak a lot to them. We don't necessarily agree with them. It's a different team, a different process, but they obviously are a source of insight, as are other people across the broader BlackRock for what we're doing, and they're great cross references because they have a different perspective on what we're doing. So that is a very important aspect that we have. This is not just the Emily and Sam team. It's not just the 40 other investors that we have on our emerging market equities team. We spend a lot of time speaking to our multi-asset teams, our people who invest in real assets, property, etc. And that's a great advantage of being here at BlackRock. Next question, because the UK is cheap, we have overseas companies buying up our better enterprises. Is there much foreign M&A in your markets? Emily?
No, there's not very much at the moment. We haven't seen that much. We have believed actually since 2010 when we launched the trust that we would see that because these companies are so cheap. We have seen in the last 12, 18 months some IPOs in these markets, which is the first time that we've seen them certainly for 5, 6, 7, 8 years. That number, we've participated in 5 IPOs over the last 12 months, all of which luckily have done extremely well. And it's really interesting for us to see that the right companies are able to attract new capital and attract investment. We've had a couple of placements actually as well on top of that. So I think we are seeing signs of some level of interest pickup.
Okay, Emily, I'm going to do a closing point here, and then we'll go to finish the questions for other people. So if people want to drop off, I'm going to do 1 more minute. Let's go back to our closing slide, just as a reminder for people what this is about. It's about growth. Extensive growth in so many different countries. It's about this yield, and people wondered, how sustainable is the dividend? I would expect the dividend to grow over time. The exact amount, probably in line with that 10 to 15% growth we talked about. It's about cheap valuations, so much cheaper than the price to make believe that we have in other markets today. You know, we're not talking about price to adjusted GMV or price to EBITDA. We're talking about price to earnings. These stocks trading are roughly 10 times earnings. That's very cheap for where we are in the world today. And it is that surprisingly low volatility. You know, it's true to say we haven't got everything right, and that's the nature of active management. You know, gentlemen ask, you know, how we've done over 5 years vis-a-vis one particular benchmark. Yeah, we've definitely underperformed over certain periods against certain benchmarks, but over the longer term track record, I think we've done very well in terms of being active in these countries. Discount management, again, as highlighted by somebody earlier, clearly it's really important this is not an evergreen fund and that people can get the value of their investments back. So that really concludes us at 3:45. I will now, people can drop off or not if they wish to. I want to go back to some of the questions. Roughly, what dollar daily liquidity or free float, if that's where you look at it, makes a stock too small for you, please? Emily.
It's a really difficult question. I mean, as a closed-ended fund, we have the ability to take a less liquid stock. However, you know, as you've heard, we like to have an active management style. We don't ever want to feel that we'd have to own a company and that we couldn't trade it and we couldn't move it. So it's unlikely for us that we would hold anything really that trades less than $500,000, $1 million a day, $500,000 a day. But we have held stuff that's a little bit less liquid than that. But we're really looking to be able to value our portfolio, you know, in 5 minutes on Bloomberg, any point.
And I think it's important to say we are not there to become controlling shareholders. You know, as a general principle, we don't want to own large portions of the free float. That's not what we're about. We're then taking small positions of a company, you know, 2-3% of a company. We don't want board representation. We are not lawyers. We're not there to change everything. We always want to be in a position that if we don't like something, we can just walk with our feet. And that's really, really important. There's no positions we're tied into, and we're not going around telling people this is the type of stock that we invest in and then being stuck into this for the foreseeable future because, you know, we keep buying it. So that's really, really important. We are not tied into any company or in any country. And at some point when management or countries go the wrong way, we can vote with our feet and leave. Next question. Does the relatively small size of your fund deter institutional investors from backing you? Emily.
I've never heard that it's a deterrent. So I don't have too much to say on that. Sam?
Yeah, I don't think so. Obviously, it'd be nice if our fund was a lot bigger. It would be nice. I guess it'd make us feel good about ourselves. But at the end of the day, the size of our fund is a function of what, you know, of where investors are putting the money. If everyone wants to buy, you know, everyone thinks it's a great story to go and buy Microsoft and Amazon and Netflix and thinks this is, you know, because it's gone up a lot, they'll continue to go up, and that's called, you know, good allocation of capital. That's up to them. This is a shareholder democracy. And we value that. So we probably would like our fund to be a bit bigger, but it can be much, much bigger given the liquidity of our markets. It's really important. We have consistently said we will not run an open-ended frontier fund. We run no open-ended frontier funds. Despite various people encouraging us over the last decade to do so, we've been consistent. We will not do so. These are illiquid markets. And as I keep repeating, we want to have the ability to go in and out of these markets when we see appropriate. So, you know, the fund could be significantly bigger, but could this be, you know, a $2 billion fund? Absolutely not. And the competitors of ours that have thought, you know, let's just raise as much money as we can in this asset class have come unstuck fairly quickly. So this is not an asset class that can be very big today. It's a really interesting and asset class for people that are long-term investors. But you know, I don't think it's really deterred people. Obviously, the fund could be bigger, but not, you know, 10 times bigger. The Thai baht has been a good currency, brackets, most of our. Doesn't this justify a higher weight? Emily, you love Thailand.
I'm saying that because it's one of my less preferred countries to invest in. I think Thai has some real structural headwinds, which is a very aging population. And also, if you look at PISA scores across Southeast Asia, the Thai ones are very low, particularly relative to Vietnam. And I think if you there's a very low R&D investment. So therefore, what they have benefited from has particularly also been autos. So a lot of their exports are auto focused. And I think as we move into EVs, that Thailand just hasn't had the investment. So I think they're going to lose a lot of export market share over that extended period as well. At the same time, Thailand obviously has big beneficiaries. What it's really good at is tourism. It's just opened up to the UK, and we hope that one day China will allow its citizens to go on holiday again, which would also be a big beneficiary for Thailand. So I think that those, return of tourists will be a big positive, but it's one of the places that I am personally more structurally negative on, because I think it's got these headwinds in the longer term.
I think we have run out of questions, albeit 6 minutes late. So thank you, everyone, for being on the call. As always, if you want to get us and ask us to answer any questions, and as I said, we've answered every single question that we've been asked. We haven't hidden away from anything. If anyone wants to ask us anything, please reach out to us, and we will try our best to give you some facts and even some opinions. Back to you, Tom.
Brilliant. Thanks very much, Sam and Emily. Thanks very much for being so frank with all those questions. I know it was appreciated by the audience from the comments that have come in. And thanks once again to the participants for staying on into the evening. I hope you've enjoyed this presentation and the whole event. And I hope we'll see you at future events. So have a good evening, everyone. Bye-bye.
Thank you.